Welcome to the Deep Dive, where we cut through the noise to get you to the essential insights. Have you ever heard a story that just, well, screams value creation? Picture this. Google, a company already worth, astronomical sums, sees its equity value jump by $1 billion.
$1 billion. Wow.
Yeah. Was it a new product launch, a sudden surge in profits? Nope. It was the announcement that they were hiring Ruth Porat as their new chief financial officer.
Ah, the CFO effect.
Exactly. Wall Street saw it as this powerful signal, banking on her bringing, and I quote, fiscal control to a company long known for its free-spending ways.
Right. That story, it instantly tells you something, doesn't it? Financial operations aren't just about bean counting. They can add or destroy huge amounts of value.
Absolutely. So today, we're embarking on a deep dive into the very tools and concepts that uncover, measure, and ultimately drive real value within a firm. You've armed us with a stack of foundational corporate finance insights and some really compelling real-world case studies.
Yeah, good stuff in there.
Our mission is clear. Extract the most important nuggets of knowledge, offering you a shortcut to understanding how firms measure financial health, make strategic decisions, and, crucially, create lasting value. This isn't just about numbers, it's about the, fascinating stories those numbers tell and the lessons they offer. Okay, let's unpack this.
And what's crucial for you, our listener, is that this knowledge isn't just theoretical. I mean, it's most valuable when it's understood and actually applied.
Right.
We're going to show you why these financial tools matter, how they directly influence a firm's path, and frankly, how they empower your own ability to make truly informed decisions. We'll illustrate how the economics of a business actually drive the numbers, not, the other way around.
That's a perfect way to frame it. So let's open up what we're calling the diagnostic kit, the ratios and cash flow statements that give us that vital snapshot of a firm's health.
Good place to start.
For our first case study, we're visiting Pipes, a medium-sized plumbing supply store. Now, it's a fictional company, but its financial dilemmas are extremely real.
And before we even look at the numbers, it's so vital to remember that finance always supports the core business. Always.
Yeah.
Ultimately, success hinges on the product market. For a commodity business like pipes, that means customer satisfaction really boils down to two things: competitive pricing and impeccable service.
And service here means?
Well, often it means having the right inventory in stock when a customer needs it, and sometimes extending them credit. That's part of the service and that kind of business.
Got it. So is Pipes profitable? Last year, their net income was, let's say, about $80,000. Now, that's not the billions we see from a Home Depot, obviously, but absolute dollar amounts can be incredibly misleading without context, can't they?
Totally misleading. And this is exactly where profitability ratios become our essential magnifying glass.
Okay.
For instance, Pipes' net sales margin means they pocket, a few cents for every dollar of sales. But maybe more tellingly, their return on equity, or ROE, was getting close to 24%.
24% ROE. That sounds pretty good for a medium-sized store.
It is. What's remarkable is that Pipes, despite its size, achieves an ROE almost on par with industry giants like Home Depot, whose ROE was around 25.5%.
Wow.
This tells you something significant. Mr. Steele, Pipes' owner, is exceptionally good at maximizing returns on the capital invested in his business. It's a really strong indicator of a well-run operation.
That's a critical distinction, and it brings us to a foundational rule in ratio analysis. Consistency. You absolutely must compare apples to apples, right?
Oh, absolutely. Using consistent calculation methods across different firms, and just as importantly, tracking a single firm's ratios consistently over time. Otherwise, you're just creating noise, not insight. It's useless.
Yeah, you're comparing oranges to, plumbing supplies.
Exactly. And what's fascinating here is how universally these ratios are applied. They're not just for internal evaluation. Capital markets use them constantly to assess firm health, and they even show up in contracts to establish lending covenants, those restrictions lenders place on firms to manage their risk. It really underscores their broad application.
But here's a common paradox that often stumps people. Pipes is profitable, yet it frequently needs to borrow money. How can a successful business be constantly seeking external financing? That seems counterintuitive.
It does, but it's often because a successful firm is growing faster than it can finance through its own internally generated funds, primarily retained earnings.
Growing pains.
Exactly. This is where the sources and uses of funds statement becomes incredibly valuable. Think of it as mapping your financial inflows and outflows. A source is anything that generates cash, like, say, reducing an asset or increasing a liability or equity.
Okay.
And a use is anything that consumes cash, increasing an asset, reducing a liability or equity.
And for pipes, what did that look like?
Well, a substantial chunk of their cash was used to fuel growth, significant increases in accounts receivables and inventory, directly supporting that rapid 25% annual sales growth they were experiencing.
Okay, so growth eats cash. Where did the cash come from?
Their main sources came from trade creditors, meaning they took a bit longer to pay their suppliers, stretching out their accounts payable, and from retained earnings, since Mr. Steele wasn't paying out any dividends. The ultimate insight from sources and uses is that it's your early warning system. It pinpoints exactly where your cash flow might be getting trapped or where your growth is demanding unexpected financing. It's really about being proactive, not reactive, to what your balance sheet is telling you.
So we've diagnosed the present with ratios and sources and uses. But what happens when Mr. Steele needs to plan for tomorrow? That's where we pivot to how firms anticipate their future through pro forma forecasts.
Right, looking ahead.
If you're Mr. Steele, walking into that bank meeting with Mr. Morgan, the banker, you must know two things, right? How much money you need and exactly how you plan to pay it back.
Absolutely. Walk in without those answers and, well, you can expect to be sent away empty-handed. It shows you haven't done your homework.
So how do you build that forecast?
Well, building a pro forma forecast essentially means projecting your income statement and balance sheet items into the future, ideally by extrapolating from your company's existing financial structure. It's about anticipating your financial needs before they become emergencies.
And there's this critical concept in pro forma called the plug figure. Can you explain what that is and how it helps reveal a company's true financial needs? Maybe using pipes again.
Sure. The plug is simply the balancing figure in your forecast. It's the number that makes the balance sheet balance, essentially.
Okay.
In earlier years, pipes might have used accounts payable as their plug, adjusting how quickly they paid suppliers to make the numbers work. But if suppliers suddenly tighten credit, that option vanishes.
Right. They can't just delay payments forever.
Exactly. Suddenly, bank debt becomes the plug. And this then clearly reveals Pipe's true financing need. For example, our sources show that with just 25% sales growth projected, Pipes needed over $500,000 in additional bank debt.
$500,000. Just from growth.
Yeah, because their assets were simply growing faster than their internal funding and existing credit lines could support. It really underscores that firms aren't just financing big assets like plant and equipment. A huge percentage of all financing is actually for working capital, things like inventory and receivables. That's often overlooked.
It's a good reminder that projecting the future is, well, it's often more art than science, isn't it?
Oh, absolutely. Forecasts are possible future outcomes, and different assumptions lead to wildly different scenarios, which is why skilled financial practitioners, people who understand the underlying business, are so indispensable.
So we've looked at annual numbers for pipes, which show that need for debt. But what happens when you zoom in? Does drilling down to, say, monthly data ever completely change a firm's financial story?
It absolutely can, and this is where things get really interesting. Most analysts, they use annual reports, but many firms, just like Pipes, experience significant seasonality.
Like a retailer before Christmas, maybe.
Exactly. Or a plumbing supplier in peak construction season. Annually, Pipes might show, say, 35 days in receivables, meaning customers pay within a little over a month, on average.
Okay.
But when you switch to monthly pro formas, accounting for those peak and trough sales variations, that number for some months could jump to almost 50 days.
Wow, that's a big difference. Almost 2 months.
It is. And for the banker, Mr. Morgan, this changes everything. What looked like a manageable loan request on an annual basis now requires significantly more capital just to cover those peak seasonal needs.
And the risk profile changes too, I bet.
Critically, yes. The collateral to loan ratio, that cushion for the bank, might decrease significantly in those peak months, making the loan inherently riskier. This insight, which you only get through detailed monthly forecasting, is absolutely vital for accurate risk assessment. It's a game changer.
Okay, so we've seen how to diagnose the present and forecast the future. Now, let's explore how financial policy itself becomes a strategic weapon and a driver of true value creation. We're moving into strategic decisions and value creation.
Right, the bigger picture.
Think about Massey Ferguson, the tractor company. In the early 1980s, they faced major challenges. Their business was risky, sure, but their financial strategy, with very high debt levels, was even riskier.
The dangerous combination.
Especially when you contrast them with their competitor, John Deere, which maintained a much more conservative debt level, maybe around 30% debt.
And when that industry downturn hit, Massey's losses weren't primarily from operations. They were from those cripplingly high interest costs.
So the debt killed them, basically.
It paralyzed them financially. They couldn't invest. They lost market share. Their competitive position just eroded. The lesson is crystal clear. It's incredibly dangerous for a firm to have a much higher debt level than its major competitors, especially in a volatile industry.
So having less debt gives you flexibility.
Exactly. A firm with more financial slack, more capacity to borrow or use internal funds can actually use it as a weapon in downturns. John Deere expanded while Massey contracted. It's almost like having a superpower in a crisis.
That makes total sense for a volatile industry like tractors. But does that mean every company should aim for low debt? What about a company like Marriott? Their CFO, Gary Wilson, deliberately targeted a 40–45% debt capital structure. How do we square that circle?
That's a fantastic question, and it highlights that there's no single right answer for all firms. Marriott's CFO believed that that particular level of debt minimized their weighted average cost of capital, or WACC.
The cost of their funding.
Precisely. Which, in theory, maximizes the firm's value. The optimal debt level isn't universal. It differs dramatically by industry. Think about a stable utility versus say, a volatile toy company. Their risk profiles and therefore their debt capacities are vastly different.
Okay, so it's industry specific. If you're trying to figure out the right capital structure for your firm, what are the critical questions you should be asking? You mentioned 3.
Yeah, 3 key areas. First, look internally. How much debt can the firm realistically service with its internally generated funds? Use your pro formas, consider best and worst case scenarios.
Okay, internal capacity.
Second, look externally. What's the impact going to be on your bankers, on analysts, on rating agencies? Are you risking downgrades or negative alerts?
External perception.
And third, look cross-sectionally. What are your major competitors doing? Ignoring any of these, like Massey Ferguson tragically did with the competitor comparison, can be absolutely catastrophic.
Makes sense. Internal, external competitors. Now, let's circle back to that Google CFO effect we started with. Why did the market react so strongly to Ruth Porat's hiring? It seems like it's all about information.
Exactly. It's all about asymmetric information and signaling. Managers always know more about their firm's prospects than the outside market does.
Right, the information isn't equal.
So the market is therefore constantly trying to read between the lines, interpreting financial policy decisions as crucial signals about what management really thinks.
Okay, so what kind of signals are we talking about?
Well, issuing new equity, for example, often causes a stock price to fall. The market tends to interpret it as management believing the stock is currently overvalued, or maybe that the firm desperately needs money. AT&T once saw its market cap fall by over $2 billion after announcing an equity issue.
Ouch. What about the opposite? Buying back shares.
Share repurchases tend to increase stock prices. It signals that management believes the stock is undervalued and consistent, regular cash dividends. Those are really powerful, credible signals of stable cash flow. Firms are very reluctant to cut them, which makes dividends sticky, as they say.
This behavior sounds like it aligns with the pecking order theory of financing.
It does, perfectly. Firms prefer internal financing, first retained earnings. Then they go for debt, which has lower signaling costs than equity. And only as a last resort do they issue equity. It's a hierarchy that really reflects how the market interprets these financial signals.
So understanding these signals is key.
Absolutely. If we connect this to the bigger picture, financial policies convey immense information. The market is always trying to decipher the meaning behind a firm's actions, and understanding this dynamic is crucial for predicting market reactions and making sound financial decisions yourself.
Okay, let's tie this all together in our final segment, Unlocking True Value, looking at valuation and ethics. When it comes to actually putting a value on a project or a whole company, many analysts still cling to simple tools like PE ratios, price to earnings. But in finance, net present value, NPV, is generally the preferred method. Why is that?
It's preferred because using NPV forces you, as the analyst, to estimate future cash flows and critically think through all the underlying assumptions.
It makes you do the work.
It makes you do the work. It makes you ask, okay, where is this value actually coming from? What are the real economic drivers here? This drastically reduces the chance of missing critical details or just accepting a number because a multiple looks okay.
And it focuses on cash flow, not just accounting profit.
Exactly. It reinforces that old saying, cash is king. It's cash flows, not accounting earnings, that truly make or break a firm. Just look at startups. They obsess over their burn rate, how quickly they're using cash, because that dictates their very survival.
And a common, costly mistake firms make, you touched on this earlier with risk, is using a single cost of capital or hurdle rate for all projects, regardless of their risk. Our sources highlight a major U.S. bank that learned this the hard way.
Oh, yeah, a classic example. They were lending to both very low-risk investment banks and very high-risk, less developed countries, LDCs, using basically the same interest rate based on the bank's average cost of capital.
What happened?
Well, the predictable happened. They lost the safe, profitable business to competitors who could offer lower rates tailored to that low risk. And they ended up accumulating a portfolio packed with increasingly risky loans and LDCs, many of which eventually defaulted.
A painful lesson.
A very painful lesson. The takeaway is clear. Always use multiple hurdle rates tailored to the specific project's cash flows, its capital structure, and its true cost of capital. One size definitely does not fit all.
And it's not just about getting the numbers right, is it? There's the politics of valuation.
Oh, absolutely. Managers have incentives, conscious or unconscious, to manipulate assumptions. Maybe understate costs, maybe overstate benefits, just to get a pet project approved. As our sources emphasize, evaluation is never about just the numbers. It is about the assumptions. And the assumptions are often about what people want subjectively, not necessarily about what is realistic. You have to look past the spreadsheet.
That human element seems really clear in leveraged buyouts, LBOs. Take Congolium, for example. Why was it an ideal LBO candidate?
Congolium was perfect. It had low debt and really stable cash flows. The LBO created significant value partly through tax shields from the increased debt the buyout structure brought.
Okay, the tax benefits of debt.
Right. But crucially, it also worked by reducing agency costs.
Agency costs, explain that.
That's the potential conflict of interest between managers and owners. When managers become significant owners through the LBO, their incentives align much more closely with the other owners, the investors. They tend to work harder, smarter, cut unnecessary costs because it directly impacts their own wealth.
Oh, skin in the game.
Exactly. Congolium even used something called strip financing to cleverly increase the nominal amount of debt for tax purposes without a corresponding increase in the actual risk of financial distress. Very sophisticated stuff.
Then there's the human element, perhaps seen most starkly in the Family Dollar case. Their board rejected a higher all-cash offer from Dollar General for a lower cash and stock offer from Dollar Tree, citing FTC antitrust risk.
Yeah, that was controversial.
How far can management really go to secure its own interests, even if it might not seem like the best financial deal for shareholders on the surface?
That's a really profound ethical question, isn't it? Managers, like all human beings, tend to protect themselves and their positions first. Now, mechanisms exist to limit this: boards of directors, shareholder lawsuits, proxy contests, but frankly, they only work partially. It's a challenging balance, especially when managerial discretion is involved.
And the board's justification for Family Dollar was the antitrust risk.
It was. That was the stated rationale. But the outcome, accepting the Dollar Tree offer, also happened to be more favorable to the existing management team staying in place. You can't ignore that context.
It's also a stark reminder that in shareholder lawsuits, shareholders spend their own money to sue management.
Yes.
But the firm, meaning management and the board, defends itself with shareholders' money too.
That's the irony. And management often wins these cases due to the prudent business judgment doctrine, which gives boards a lot of leeway. It brings us back to a core ethical point, I think. Which is act ethically. It is just so easy to rationalize one's actions. The fact that maybe others are doing it or that something is technically allowed by the rules, that doesn't automatically make it right. At the end of the day, each individual remains his or her only true gatekeeper. The lesson for us looking at these cases is to always question, always dig deeper into the why behind the numbers and the decisions, always understanding that human incentives and biases are inevitably at play.
So wrapping this up, what does this all mean for you, our listener? The ability to understand and apply these financial tools is about far more than just crunching numbers. It's really about making better decisions for a firm and ultimately for yourself in pretty much any professional context. It's a lesson that truly adds value.
Absolutely. We've explored how ratios provide that vital diagnostic kit for financial health, how pro forma forecasts help anticipate future needs, often revealing surprises like seasonality, and how capital structure isn't just some accounting detail, but a genuine strategic weapon.
Right. And we saw how the market reads signals in financial policies and the rigorous analysis required for true valuation.
Always mindful of those human and ethical dimensions that are inseparable from the numbers.
Remember, a profound insight from our sources, worth repeating, is that how a firm is financed matters immensely and critically. The economics drive the numbers do not drive the economics.
Well said. And maybe here's a provocative thought to leave you with. When you're faced with a project or an investment that promises a positive NPV, meaning it supposedly adds value, can you explain why that value is being created in 5 sentences or less?
The why test.
Exactly. If you can't articulate the source of that value concisely, the competitive advantage, the market inefficiency, whatever it is, then it's probably worth questioning the NPV itself. This simple rule forces you to critically think through the underlying economics and competitive realities, rather than just blindly accepting the figures on a spreadsheet.
That's all for this deep dive. Thank you so much for joining us. We hope you've gained some valuable insights to help you navigate the world of corporate finance with greater clarity and confidence.